Thank you very much, Stephen, and thank you to all of you for bothering to turn up and listen to us for this afternoon. I hope that some of what we say will be vaguely of interest and useful. We've got two star speakers today whose subjects of making international regulations and Brexit I'm sure you'll find thought-provoking. Given the overseas flavour of what they're focusing on, I thought I'd focus today a little on how we approach our regulatory task within the bailiwick and on what we've been doing over the past year, offering a few reflections whilst highlighting some of those things which we've done to innovate or to facilitate innovation. Regulation, as I'm sure you're all too aware, is often complex, and there's a big danger of not being able to see the wood for the trees. Andrew Bailey recognised this when he moved from being Deputy Governor at the Bank of England to become Chief Executive of the Financial Conduct Authority. There he found a regulatory body with a huge range of legal duties and an almost infinite number of ways of approaching those duties. He sought, with his colleagues, in the absence of much academic literature on financial service regulation, to write a guide as to how the Financial Conduct Authority should approach its duties. You should have on your seats today two booklets, because in Guernsey, Commissioner Hobbs thought it would be very helpful for the Commission to produce a similar document to try to better explain to a lay audience, albeit an educated lay audience, why we do what we do and how we do it, with the added layer of explaining why we won't be able to fix every problem all the time and why, in a democratic context, you wouldn't wish us to be able to do so. He then bent himself to the task, and you've got the result of his labours, which has been through ourselves, and I hope that you find our regulatory framework is interesting alongside its companion, Risk-Based Supervision in Guernsey, a document which we first published last year, explaining our approach to supervision in some detail. I'm going to start today by precising some parts of our regulatory framework publication, before turning to how we've implemented it in practice in 2007 in the second part of my talk. So, the purposes of regulation. Some free spirits. I'm sure many of you in this room might wonder why there should be any regulation of financial services. Firstly, it should be recognised that regulation pervades much of our lives in the public interest. We want to know that the aircraft in which we fly are airworthy and that the pilot's competent. Likewise, we want to know that ferry is seaworthy. We also want the nuclear power from France to be safe and the food we eat to be wholesome. These are obvious. Financial services is less obvious. Some of the same reasoning applies, but there is also some additional reasoning. An overarching reason, of course, for regulation is information asymmetry. Few of us are knowledgeable nuclear or food scientists. We have to rely on regulation. Equally, few of us can tell whether the bank at which we deposit our savings is solvent now and is likely to be so in the future. Many risks in other regulated industries are independent of one another. A pilot can make an error, but it doesn't follow that all pilots will. In financial services, conversely, risks may be systemic. That is, a failure in one place can lead to a failure in another. The banking crisis of 2008 well illustrates the point. Financial regulation addresses systemic as well as idiosyncratic risk. A further characteristic of financial services is their potential duration. A long-term savings or investment product may have a long period of latency. It may be many years before it's discovered that a serious problem exists. Financial services, they're also abstract. Many are effectively a promise to pay at some future date. The terms are expressed in a contract, the enforceability of which will depend on the standing of the counterparty, possibly many years in the future. Economists see this as an aspect of so-called power asymmetry. In short, this refers to the financial institution being big, with strong knowledge of its products, while its retail customer is small and has less knowledge. And then there's a quite different point to consider. Public bodies can do some things more efficiently than market participants individually. Either they be too expensive or legally impossible for a market participant to do. Such economies of scale can reduce transaction costs, attaining common standards, enforcing market discipline, and keeping out people who are intent on competing unfairly are best achieved centrally. Whilst regulation can help address issues such as information asymmetry, it's certainly not a solution to all concerns within financial services. Regulation will not help further people's education, and it cannot, alone, address the issues of consumer access and financial inclusion. As a regulator, we may not take action because it is not within the objectives given to us by the States of Guernsey, or because the issue to be addressed is a matter of broader public policy, of which financial regulation may be only a small part. Markets depend on confidence to work at their best. Economic prosperity depends on market confidence. Regulating financial markets effectively and proportionately enables not just the bailiwick's own inhabitants, but businesses and individuals internationally to have confidence in the bailiwick. Where projects are internationally mobile, one aspect of the final location choice will be confidence that the location will be stable and predictable. Proportionate, well-considered regulation contributes significantly to the stability and predictability that creates confidence. So, just a few reflections on how regulation can work in a liberal democracy. Much regulation is about ensuring that only people and institutions with the right behaviours are allowed to operate in regulated markets. The key tools regulators use are barriers to entry, such as a fit and proper test for individuals, and monitoring through the supervision process that standards set in rules are met. Those tools will not always work, not least because the public interest is not best served by a zero failure regime, which would eliminate all risk at the expense of pretty much everything else. The Commission supervises over 2,000 licensees of varying scale and complexity. They present a wide range of risks to the public interest, and their impact will vary from severe to negligible. Clearly, a systematic approach is required to allocate resources to the management and mitigation of these risks, and the International Monetary Fund expects jurisdictions to have such an approach. Financial services regulation in liberal democracies does not seek to produce an outcome where no institutions ever fail. This is because to do so would result in such intense regulation, both in terms of standards and supervision, that the cost to the consumer would be unacceptable, both in direct cost terms and through the reduction in choice and availability. In consequence, market participants, including customers, must accept that there is some risk of failure. They should exercise prudence accordingly. If an offer is too good to be true, it probably is. For its part, the Commission will endeavour to strike the right balance, given the prevailing market conditions, between the customer detriment arising from loss and that arising from lack or loss of choice and affordability. Many decisions we take are necessarily taken under varying degrees of uncertainty. More time taken will often make a position clearer, with the expense of action taken too late. Regulators do not have the luxury of infinite time to take the correct decision. The Commission relies on the experience and the expertise of its staff to get as many decisions right as possible. So, if I may, to turn from theory to practice, if what I've just said gives some feeling for both why and, in theory, how we approach regulation, I'm now going to move on to talk about the practical realities of how we've regulated over the last year and what we have found. During the course of the year, we've filled the role of a broody hen, or an incubator if you like, in a number of policy areas. We continue to work on revision of laws. Our scans continue to confirm that the chicks in the revision of laws' eggs still have beating hearts and are growing steadily, and we hope to have a few of the brood hatch soon, with a view to ensuring that all our financial service legislation is aligned, compatible with international standards, and somewhat easier to follow over the course of the next year or so. Secondly, we've also listened to the strong desire of many of you in industry for pensions regulation, and I hope have delivered a reasonably formed pensions regime in little more than 6 months in the first part of this year. We've also been undertaking many other policy projects, the sorts of things which we must do year in and year out to keep pace with the burden of international regulatory change. I do appreciate, that these are burdensome for you to implement. They're also burdensome for us to take forwards, and we much appreciate the voluntary help which we receive from the industry associations and others in our policy development and testing working groups during the policy incubation phases. We do hope that this generally enables us to consult on better considered proposals than would otherwise be the case. We fully appreciate that you will not necessarily like all of them. Believe it or not, neither do we. We're perfectly capable of consulting on policy proposals which we might consider, left entirely to our own devices, to be a little bit over the top. That we are consulting on them is almost always because there is an international imperative for us as a bailiwick to comply and to be seen to comply with international expectations in order to maintain our reputation for being a constructive and cooperative member of the international community. We're also engaged in policy projects designed to create a climate conducive to financial services innovation. Adair Turner famously noted after the 2008 financial crisis that not all innovation is good innovation. In Guernsey, we are interested in good quality innovation, which helps put the financial services sector on a trajectory of sustainable growth, the sort of innovation which does not leave our enforcement team to pick up the pieces after the design flaws become apparent. In connection with this, in addition to international pensions regulation over the last 12 months, we have delivered the Private Investment Fund and seen it adopted by innovative local lawyers seeking to provide high-value structures to their clients. We have also, through the Lending, Credit and Finance consultation, proposed to establish a regulatory structure for lending businesses conducive to lending and equity raising businesses which wish to be properly regulated but which do not wish to become banks. We also used the LCF consultation to invite views on a number of regulatory concepts, namely green funds, regulated electronic customer due diligence providers, and electronic agents. Most recently, we have consulted on possible insurance solvency reforms as we work to ensure the bailiwicks firms are as well positioned as possible for free trade in the global insurance market. Not all of the innovative ideas we consult on will necessarily come to fruition, but through our Innovation Soundbox, we seek to be open to innovative proposals by industry and to work with the proposer to establish how the innovative vehicle could best fit into the bailiwick's financial services architecture, such that consumers are appropriately protected, financial stability safeguarded, and innovation appropriately incubated. I'm not going to talk very much about Brexit today because I've got Deputy Chief Minister Trott here to do that. But before turning away from policy, I'll note that as the Commission, we're burning countless hours working closely with the states and others to position the bailiwick for a post-Brexit world. As we are already outside the EU, much will remain the same, and we can, in some sense, claim to be a beacon of stability, albeit that the type of trade deals which the UK strikes with the EU, or not, and its future deals with other major economies are important, and we are seeking to ensure that you, as our entrepreneurs and industrialists, have good quality access to overseas markets going forwards, so that you can exploit the bailiwick's competitive advantages while being incentivised to develop new skill sets to produce new niche products for new markets as the post-Brexit trade structures become clearer. Turning from policy to practice, our authorisations team have been busy as usual. We processed between June last year and July this year a total of 438 applications and exemptions, including 48 relating to insurance firms and 199 relating to investment firms or funds. Also, in the same period, the authorisations team processed 3,081 appointments and 2,511 resignations, which is certainly a testament to the liveliness of the jobs market at a senior level within the bailiwick. We've also dealt, in our capacity as a de facto marriage registrar, with 58 changes of controls. These are often burdensome for us, as we take our duties seriously and, more often than is the case with marriages between people, there are often lawful reasons for changes of control not to be granted, which need to be properly considered to protect consumers and financial stability. We consulted on charging for our change of control service this year, because whilst we have a strong public service ethos and accept that some degree of cross-subsidy is inevitable in some areas, we just don't think it's right that those firms which are happy to remain single for their whole existence should be endlessly paying for the long hours we burn preparing for marriages between firms which appear to us to be anything but monogamous. We appreciate that when you're transacting with us for statutory purposes, you'd like the process to be as easy and as quick as possible. We've continued, throughout this year using our in-house developers to make improvements to our firm and director-facing software so that it's as easy as possible to provide us with the information we need in order to effect a registration or approve an authorization. I'm delighted with the unsolicited feedback I often receive about the quality of the interaction you have with the human parts of our authorizations team, which they consistently work hard to ensure that our service level standards are met. The computer-based parts of the authorizations process will continue to be developed, though our quest for artificial intelligence in an online portal, sufficient that it charms its users, as well as diagnosing and curing itself, is sadly some way off. Turning to supervision. Supervision continues to take up a great deal of our time and energy across the funds and structures we regulate. Whilst I don't intend to take you through all the detail of our work in this area, I thought I'd put up a couple of slides and highlight a few of the statistics so as to offer an idea of the magnitude of our activities in this area. For example, we dealt with 1,338 triages, which are regulatory matters worthy of recording and possible action, as well as implementing 270 new risk mitigation programme actions connected with 140 separate risk issues. The slide shows, I hope, the volume and depth of the matters with which we are engaged. Moving on to the next slide, we can see a further breakdown of those statistics, this time by division. I appreciate that these are a little challenging to read if you're towards the back of the hall and probably on the balcony, but all the slides will be available on the Commission's website, as Stephen just noted. My colleagues will talk in greater detail tomorrow about the particular risk areas where we have concerns, but to give you some idea of our key areas of concern, if I looked at the types of RMPs we were writing as of June this year, governance tops the table. The Chairman will talk about this more today, and it's noteworthy it's just overtaken financial crime as our most frequently occurring unacceptable risk area. Conduct risk remains an area of concern, though it's markedly less prominent than at the same period last year, while firms running inappropriate operational risks have become a prominent feature of our supervisory assessments. I thought it might be helpful to give you a flavour of some of the underlying issues at some of the firms we inspect, rather than just talking about them at a high level. I must, however, caveat what I'm saying, in as much as I'm talking about issues which arise, which require mitigation by us, note mitigation, not enforcement, at some of the firms we visit. From that, it certainly and thankfully does not follow that the bulk or even a lot of the financial services companies in Guernsey have the issues I'm about to highlight. Nevertheless, I hope it's helped to give you some flavour of the sorts of things which are currently concerning us. I'll talk first about governance. Issues there include, firstly, a huge variation in a firm's understanding of its own risk appetite throughout the firm. This can be a real case of the left hand not communicating with the right hand. When you talk to one person at the firm, they say, oh, our risk appetite's here. And the next person you talk to around the corner, they say, oh, risk appetite's there. Generally concerns us a little bit. And it can be allied to having weak non-executive directors and a general lack of challenge in the boardroom. There's also the issue of inappropriate direction of the legal entity board by group. Clearly, we might expect Group Board to offer a steer as to the direction a Guernsey subsidiary should take, but when Group issues instructions in fashion which goes against the Board's duty to comply with local law, that becomes troubling. Then on the fund side, we've seen a little bit too often, well, too often to be simple, a failure to either acknowledge or appropriately manage conflicts of interest. We certainly don't live in a pious world where conflicts of interest magically don't exist. But we do expect boards to understand when they exist and to manage them properly. Another issue we see in connection with some funds is a failure to oversee the underlying assets appropriately. Then in the fiduciary area, we occasionally find businesses which simply don't understand the structures they are administering. We generally find people or corporates being directors of things they don't understand troubling, although fortunately this isn't one of our common findings. When they fail to understand that several of the businesses they are administering are, in their own rights, financial services businesses requiring regulatory permissions to operate legally, our concerns can become exacerbated. And then, of course, sadly, we have seen firms where boards have clearly taken the wrong decisions for customers. to meet the short-term financial needs of the regulated entity. This clearly isn't good, and neither is the failure of the governing parts of the firm to ensure appropriate financial crime and conduct standards are applied. I'll turn to these now. Under the broad heading of conduct risk, we've seen issues connected with firms failing to undertake reasonable compliance checks when transferring in customers from another firm, a failure to properly safeguard the interests of underlying pension fund beneficiaries, poor advice to new clients, and palpably poor investment choices. Here, to be clear, we're not talking about investment managers which have simply failed to buy what, with the benefit of hindsight, turned out to be the best performing shares, but rather making investment choices which were simply not aligned in any sense with the customer's interests or risk appetite. Turning to financial crime risk, we see a number of issues repeated at a number of firms. Firstly, we see too many poor business risk assessments, which appear to have been ordered by somebody to put on a shelf rather than being created by the firm to actually reflect the types of customer a firm has and the risks they present. To pick a hypothetical example, having a business risk assessment written around a Guernsey resident customers is likely to be inappropriate if the bulk of your client base is Eastern European or Middle Eastern. So it's worth thinking about how well they actually align with the business you're doing. Then, allied to poor business risk assessments can be poor customer due diligence. This is another key financial crime issue which we uncover too often in the firms we visit. I'm sure this will shock almost all of you in this room, but we've come across cases where as many as 90% of the files we have reviewed had incorrect or absent customer due diligence information. In other cases, we have come across firms which seem to operate as if the anti-money laundering handbook did not exist, whilst overdue risk reviews on established customers can also be troubling. Allied to this, we can come across poor compliance monitoring programs, inappropriate reliance on those introducing a client to a firm, not to mention relying on memory rather than written records within the firm as the source of a client's worth. I appreciate you may well have discovered orally how a client came by the money, but it's sort of worth documenting it to put it on the client's file. What we find particularly concerning, turning again to governance risk, is when these issues have arisen as a result of a poor compliance culture at all levels, or because of a failure to act on a risk mitigation programme action, which we gave a firm following a previous risk assessment visit. Finally, for this part of my talk at least, I'll turn to operational risk, where we're seeing a number of issues which bear future consideration. And I say this in the context of cyber risk increasing markedly and us all needing to be more aware about the threat which we face of having our firm systems penetrated and customer data stolen. Too often we see staff who do not understand the processes they're meant to be following. A key here is that there has to be a focus on implementing processes properly, not just on writing them. We also see poor pricing processes for assets, perhaps allied to a failure to safeguard the assets. That can also be combined with poor documentation and poor control over outsourcing. Then, of course, we see sometimes firms scrabbling to try to correct some of the risks they've identified. That actually weirdly gives rise to an alternative operational risk, which is if firms try to do too much too quickly. This can lead to firms running too many change projects simultaneously with non-optimal outcomes for all of them and insufficient staff to execute any project well. This is particularly troubling in the IT area, given what I was just saying about the ever-increasing cyber risk which we all face. I'd like to reiterate, having sort of given that potted summary, that the good news is that we haven't yet found any of the above issues at more than 95% of the entities to whom we issue licenses. That is, it is a very small minority of firms at which we find any of those issues. That said, those of you in the room whom we have yet to inspect might find it helpful to assure yourselves that your firms would pass muster when assessed by us or by somebody else for their vulnerability to some of the issues I've just talked about. Fortunately, most of those of you in this room are self-starters, interested in continuing professional development. Otherwise, I suspect you wouldn't come along and listen to our talks today. So I wanted to take a few moments to outline a logical development of something which we're already doing informally, to help put you and your teams in a position where we can help you to assess your own understanding of the regulatory laws, so you don't need to worry about as much about supervisory visits. At this event last year, I said that we'd held over 20 educational events for industry to help those who wanted to follow the law understand better what they could do to ensure that they were following the law. We've been continuing these education-focused outreach activities, and today I just wanted to outline how we're going to try and evolve these sessions a little further going forwards to help that you, or those of your teams who attend, to derive maximum value from them. From now onwards, you should find that, firstly, we will normally aim to state at the beginning of an educational session what outcomes, in terms of knowledge acquisition, should be achieved by those attending by the end of the session. Secondly, all educational sessions which we run for the financial service sector ask you to reflect on how you are doing in comparison with what we've been talking about at the end of the session. And thirdly, we will generally provide those attending with a themed self-assurance help sheet or questionnaire at the end of the session, which the person attending will be able to take back to his or her office and discuss with colleagues. We hope that through these innovations, we can help those of you who wish to ensure your firms obey the law to further develop whatever self-assurance practices you already have in place. We want to provide an environment where it becomes normal practice for those returning from knowledge-sharing sessions with the Commission to discuss what they've learnt with colleagues and reflect with those colleagues on what they need to do to assure themselves that they're meeting their legal requirements in an appropriate, proportionate, and not over-the-top fashion. To be clear, we do not intend to start asking you to return the self-assessment questionnaires to us. I have a strange feeling that if we started to do that, our educational sessions would suddenly become markedly less popular. Nor, as a matter of general practice, are we going to start asking you to take a test on what you've learned on an individual basis before you leave one of our sessions. Although, in the spirit of encouraging pediological diversity amongst my colleagues, I certainly don't rule out there being group question and answer sessions during the course of an event. No one should think that, because a member of his or her team is dutifully attending our education sessions, that we won't come and visit his or her firm. We're not seeking to encourage self-assurance as an alternative to formal supervision, but as a complement to it. We like to have our jobs made as easy as possible for us, and firms which do good self-assurance means that we have to do much less work, which generally pleases us. Some firms are very good at reflecting internally on how good is their adherence to the law, and then working without prompting to fill the gaps. Such self-awareness and empowered internal discussion perhaps would come less easily to some of the firms we visit. There are various models of self-assurance which are used already by a number of non-financial UK regulators to good effect. We hope you'll find the version we are gradually implementing helpful in your endeavours to develop your businesses in a proper and profitable fashion. So if I turn from, I suppose, us being about as warm and cuddly as we ever get, the self-assurance bit, to us being less warm and cuddly. I think it's only proper to talk about what we're doing on enforcement. I talked at the beginning of this session how hard we're working with government, with GIBA, with others, to make sure that the bailiwick puts its front foot forward, so that we maintain our good reputation for having good standards, because this is an important part of the bailiwick's proposition. Our enforcement division helps you ensure that that is actually what we deliver as a bailiwick. We use our enforcement division when we find a problem, or rather our supervisors discover a problem with a firm where an amicable resolution would be difficult or inappropriate given the nature of the discovery. I talked earlier about a lot of numbers to do with our supervisory activities. To give you some sense of contrast, between July last year and June this year, the supervisory divisions made 9 referrals to enforcement. Can I just repeat that? Because I know there's some people who try to big this up. I said 9, not 90 or 900. And Not all of those related to regulated firms. Some related to people illegally conducting financial service activity outside of the regulated perimeter. The overall number of cases supervisory directors referred to enforcement remains very small compared with the 190 risk mitigation programme actions which were open at the end of June, which seek to deal with material issues at regulated firms using more collaborative techniques. Callum McVean is going to talk later today about the particulars of cases we have seen when we can talk about them. Some obviously we can't talk about because they're sub judice at the moment. But I wanted to use this talk to reiterate a few key messages about our use of enforcement, which I think bear repeating. Firstly, we are not, and we don't wish to be an enforcement-led regulator. Every enforcement case the Enforcement Division takes on has to be referred to it by a director or deputy director of a supervisory division. The supervisory directors only make referrals when matters are serious or where there has been what I would term repeat offending. Secondly, we have no desire to take petty matters to enforcement, and our enforcement team is stretched carrying out investigations into the serious matters which have been referred. When the NHS was set up, the notion was popular that there was a finite quantity of ill health, which, once treated, would mean that everyone was healthy and that healthcare costs fell. As we all know, about 70 years later, it didn't quite work out like that. Similarly, I know that some of my colleagues hope that, having dealt with a residue of poor quality individuals and firms, the work of the enforcement team would tail off. Having now supervised firms for nearly 12 years, I always thought that view was at the far end of the optimistic spectrum, and our experience of the past 4 years is that as our supervisory teams become more focused, they are better at finding serious wrongdoing, which requires referral to enforcement. Much though I'd like to paint a picture of a time when we don't need to enforce, I don't think that's realistic anytime soon. Rather, I fear there'll always be a residue of unscrupulous individuals seeking to exploit and thereby harm customers, investors, and Guernsey, and that we'll need to continually work hard to keep them in check. Access to other people's money can, unfortunately, create an environment where people who would otherwise lead relatively blameless existences seem to choose to do the wrong thing. That's an empirical observation based on having supervised in 3 countries, and I think it's just one of those sad realities of life. Third point I want to make is that we'll listen to well-argued cases, even once a firm or an individual has been referred to enforcement. Sometimes we discover things are not as bad as the supervisor feared when the referral was made, and the firm or the individual is taken out of the enforcement process. We obviously try and avoid cases which are not serious going to enforcement, but the analytical rigour and the depth of an enforcement investigation can bring facts to light which cause us to change our minds. Another point I wanted to make very clearly today is that there is no target for the Enforcement Division to take a certain percentage of referrals through to a formal sanction. When we learn matters are not as serious as we feared, we happily discontinue cases. As I said, we have many serious cases to deal with, and if we discover things aren't bad, we're more than happy to revert to supervision. Fourthly, we do not, and we won't run away from well-resourced legal teams. I'm not here pretending that we don't sometimes find it challenging to fight somebody who can command a string of Queen's Counsel, but we do have a strong in-house litigation team and a strong investigation team, and will be guided by the evidence, not the size of the firm or the power of the individuals running it. When we do find, over the course of an investigation, evidence of individuals seeking to escape justice through use of their connections, we will generally regard that as an aggravating factor to be taken into account when determining what sanction is appropriate. Fifthly, some of you have given feedback about our public statements that they're too bland, and we are working to try to make them as full as reasonably possible so that the learning value of them is maximised. This is part of our efforts to help you with self-assurance. The last thing we want to do is put out public statements which cause you all to become far more risk-averse than you should be because we haven't put some detail in which highlights quite how bad was the case of the entity against whom we took action. I think my final message on enforcement is that you should all be reassured that the Commission has an effective enforcement team. Without it, those of you in this room who seek to conduct business properly and honourably would risk being undercut by those without scruples who, even if they fail to directly damage the business you run, would damage it through undermining the reputation of the bailiwick as a good place in which to do business, a reputation on which you all depend in order to be able to continue to supply services to your customers and clients. I hope that what I've said today has given you some idea of why the Commission regulates, the issues with which it is engaged, and some understanding of how we are approaching those issues. In the areas in which we operate, we seek to add value to the bailiwick. We'll continue to seek to work with the states and the industry to develop useful innovations. We will continue to work to help the bailiwick be sensibly compliant with international standards, with as good an access to overseas markets as possible. We will also continue to develop our authorisations, supervision and education activity, and we will continue to use our enforcement team to help create an environment in which the good, skilled and hard-working can prosper, with the reckless and the wrongdoers facing justice. We'll do this in an environment informed by both Brexit and the ongoing development of global standards, things upon which our subsequent speakers will dwell. And just before I hand over to Stephen, I'd like to sort of particularly thank Vicky for coming here and giving us her time to give us her expertise this afternoon in her capacity as chairman of the International Association of Insurance Supervisors. But thank you very much for listening very patiently for 40 minutes. Stephen.